Okay. Hello students, welcome to my class. This is Professor Vincent Usaya, and this is part 2 of chapter 2 presentation. Chapter 2 zero in on recording business transactions. So this is where we left off in part 1. Here we are going to talk about debit, credit, and normal account balances using double entry accounting and T account. Recall at the beginning of part 1, I told you about the importance of being comfortable with all these terms. It is very critical for you to succeed in this class. So that being said, let's take a look at the first question here. What is double entry accounting? That's another terminology. First of all, we already know what a transaction is. We said that every transaction has to be recorded in at least 2 accounts. That is what we mean by a double entry system. In other words, every transaction has to be recorded in at least 2 accounts. Now the key word here is, I said at least. In other words, it could be more. In other words, every transaction will affect 2 accounts. So let me give you an example. The company goes to Best Buy to buy a computer for $1,000. When the company buys the computer, what happens with $1,000? Cash of the company went down. So cash account is affected. So we need to record that transaction in cash account. Then on the other hand, we have computer, and we need to keep track of the computer that we have. So computer account is also affected or impacted by that transaction. But we have a situation whereby more than 2 accounts can be affected. So let us modify the example that I just gave you. Suppose we went to Best Buy and we paid only $200 out of $1,000. That means we owe Best Buy $800. Then we need to keep track of our obligation to Best Buy, so we have to record the $800 in accounts payable. So in that instance, we paid cash $200, we owe Best Buy $800, and of course we have additional computer. So 3 accounts are being affected. So moving along, that's a very important concept. Let's take a look at the T account. Here, remember I told you that a ledger is simply an accounting book. It could be a loose leaf binder, it could be a big book with blank pages or design in a particular way. So listen to this very carefully. A T account is a representative of a page in the ledger. What does that mean? What does that mean? So let's assume that this is a ledger. Remember I said that if a bank have 2,000 customers and we have 2,000 pages right here, each page is for 20 customers, right? Now, in real life, we actually have real accounting book like this, and we can flip 2,000 pages. But in the classroom, we don't have an opportunity to flip pages. Because we don't have an opportunity to flip pages in the classroom, we came up with a very convenient way of representing a page. So we call it T account. So it is very important for you to know this. A T account represents 1 page in the ledger. In real life, we really don't use T account because in real life we have actual accounting records. Okay? So here are additional things you need to know about the T account. Here you need to commit to memory. We said that the left side of the T account is called the debit and the right side is called the credit. And that is applicable for any type of account, be it asset, liabilities, equity. The left side is debit, the right side is credit. Moving along, increases and decreases in accounts. Okay, so remember we said that one of the things we are doing, or the main thing that we are doing in this chapter, is recording business transactions. A transaction causes an increase or decrease in a particular asset, liability, equity account. So every transaction will increase or decrease some accounts. And of course, as you know, we have three main accounts: assets, liabilities, and equity, with several types of each of them. So how do we record the increase and decrease in this account? That is the main issue here. And we have what we call debit and credit rules. All right, debit and credit rules. I know that most of you must have heard about debit and credit. Okay, some people actually say that accountants do nothing but do a lot of debit and credit. That is very true, and you need to take a look at how we apply the debit and credit rules. Now, here, anytime our cash goes up or an asset goes up, we will debit the cash account. Remember now, we said that the left side of every account is debit and the right side is credit, and that is applicable to every account. Now, when cash goes down, we credit. Now, keep that in mind, and let's take a look at let's talk more about the rules of debit and credit. Now, you really need to catch this. This is huge, because we are going to be doing a lot of these for the remaining part of the chapter. Now, at this point in time, I encourage you to memorize the debit and credit rules. It probably might not make a whole lot of sense to you right now, but it will eventually. Just like your traffic light. When you are driving and you see red, you stop. That is the rule. When green, you go. So, to a large extent, initially, you are encouraged to memorize it. Like I said, eventually, it will make sense to you. Now, that being said, let's take a look at the rules. What are the rules saying here? Look at this. The accounting rule says anytime there is an increase in any type of asset account. What is an example of an asset account? Cash, accounts receivable, equipment, land. Anytime there is an increase in any type of asset account, we debit. Like, of course, as we indicated earlier, for every account, it doesn't matter which type of account, the left side is debit and the right side is credit. So for any asset account, any increase with debit, any decrease with credit. Look at liabilities. For liabilities, any increase with credit, any decrease with debit. Oops. Stop right there. As you can see, the accounting, the debit and credit rules, they are opposite. For assets and liabilities, they are opposite of each other. Now, let's take a look at the third component. 1, 2, 3. These two components or parts are very easy. Any increase in asset, debit, any decrease in asset, credit. The opposite is true for liabilities. Now, but when it comes to equity, things get a little bit complicated. Why? Because equity is divided into two main parts: contributed capital and retained earnings. All right? Now, under contributed capital, we have an account called common stock. The debit and credit rule says that anytime there is an increase in common stock, we credit. Anytime there is a decrease, we debit. As you can see, that is consistent. The debit and credit rules of liabilities and common stock are the same. Now, let's take a look at under retained earnings. Dividend. Take a look at this. Anytime there is an increase in dividends, we credit. Anytime there is a decrease, we credit. As you can see, it is the same rules as assets. Now let's take a look at revenues. Revenues, anytime there is an increase, we credit. Anytime there is a decrease, we debit. Look at expenses. The expenses is the opposite of revenues. Now, I know you are thinking now, wait a second. This is very confusing. Why are we doing this? Like I said, it doesn't have to make sense. At this point in time, I just want you to memorize these debit and credit rules. Then we learn how to apply them eventually you are going to see how all the pieces are put together. So that being said, let me give you another way of learning the debit and credit rules. I think this probably might be an easier way than what they did here. But if that is not the case, you can go ahead and do it your own way. So take a look at what I'm going to do here. I'm going to have here two boxes, all right? Underneath each, I'm going to have the T account. Recall we said that the left side of the T account is debit, the right side is credit, the left side is debit, the right side is credit, for any type of account. So look at what is going to happen here. How many types of accounts we have? Assets, liability, common stock, dividend, revenue, expenses. So what is going to happen is we are going to line up these 6 items into these 2 boxes. So the first one is assets, and the second one is dividends, and the third one is expenses. So we have assets, dividend, expenses. Assets, dividend, expenses. Listen, look at what happened here. Then, in this box, look at what we are going to have here. Liabilities, common stock, and revenues. Now, listen, this is very important. 1, 2, 3, 4, 5, 6. That is as far as it goes. If a company has 5,000 accounts, all the 5,000 accounts are either this, or this. It doesn't go beyond that, because this is more or less like the full scope, like the human body. You can go to medical school for 20 years and specialize in different areas. Everything that you study revolves around the human body. So let's take a look at how these rules work. Listen to this, you need to catch this. What this formula is saying here is, anytime there is an increase in any asset, dividend, expense account, we debit. Anytime there is a decrease in any of these, we credit. Look at liability, common stock, revenue. Anytime there is an increase, we credit. Anytime there is a decrease, we debit. Again, don't worry about whether this makes sense or not. We are going to talk about the applications in a minute, and that will make sense to you. Now, moving along, let's take a look at the normal balance of an account. Now, all accounts are summarized on one side of the T account called the normal balance. What does that mean? In other words, in summary, what we are talking about here is the balance of these accounts. Because debit side is the increase side, the balance usually will be on the debit side. For all these accounts, because the increase side is credit, the normal balance will, the balance will be on the credit side. Think about your checking account. The normal balance of your checking account should be what? Black. In other words, your checking account should have a positive balance. That is normal. But sometimes if you overdraw your credit account, you can have abnormal balance, and that would be negative or black or red. So that is basically what we are talking about here, and we are going to go ahead and expatiate on that eventually. So the normal balance of an account, take a look at this diagram. This diagram simply it summarizes everything that I just explained to you. So moving along, let's take a look at the application. So at this point in time, let's wrap up part 2, and we are going to start part 3 with the application of debit and credit rules.